You're 32 years old, scrolling through Zillow at 2 in the morning, and you see it. A 3-bedroom fixer-upper in a decent neighborhood. Nothing special, needs new floors. The kitchen looks like it hasn't been updated since 1987, and there's some concerning water damage in the basement photos they tried to hide with creative angles. The price? $847,000. You check the property history because something feels off. This same house sold for $340,000 in 2019, 6 years ago. You close the app, you make $170,000 a year. You're in the top 20% of earners in this country, and you cannot afford a median-priced home in your city. Your parents bought their first house when your dad was 26. He was making the equivalent of $68,000 in today's dollars. Working a union job at a factory, 3-bedroom colonial, quarter-acre lot, 30-year mortgage at 6%. The payment was 22% of his gross income. You've done the math on that $847,000 disaster you were looking at. With 20% down, which is $34,000 you don't have, your monthly payment would be $5,200. Add property taxes, insurance, and basic maintenance, you're looking at $6,300 a month. That's 44% of your gross income. And that's if you can even scrape together the down payment, which at this point would take you 4 more years of aggressive saving while rent continues eating 32% of your paycheck. So you do what everyone tells you to do. You cut back, no more eating out, cancel the subscriptions, start a side hustle, wake up at 5 in the morning to drive for Uber before your real job. And you know what happens? You save an extra $900 a month. Congratulations. At that rate, you'll have your down payment in 3.1 years, assuming home prices don't go up at all during that time. Except they will. They went up 8% last year. So you're not actually getting closer. You're on a treadmill, running faster and faster, and the house is moving away from you at the same speed. Here's what nobody wants to tell you. You're not failing. The game changed, and nobody sent you the updated rulebook. In 1970, the median home price was 2.3 times the median household income. You could reasonably expect to buy a house if you had a stable job and saved for a couple years. Today, that ratio is 7.8 times median income. The math doesn't math anymore. The system that turned your parents into homeowners, that built the American middle class, that created generational wealth for millions of families, that system is broken for you. And here's the part that's going to sound insane. The part that might make you click away from this video, but I need you to hear it. What if I told you that being priced out of homeownership is the best thing that could happen to your wealth? I know how that sounds. It sounds like cope. It sounds like someone trying to make you feel better about losing. But this isn't a cope video. This is mathematical reality, and the numbers are about to make you very uncomfortable or very excited, depending on how you look at them. Because what I'm about to show you is why homeownership, the thing you've been told your entire life is the foundation of wealth building, has become a wealth trap for Millennials and Gen Z. We're going to expose the hidden opportunity cost that's destroying future millionaires. We're going to look at what the actual data says about renting versus buying in 2025. Not what your uncle says at Thanksgiving, not what some real estate agent trying to make a commission tells you, but what the numbers actually show when you run them honestly. I've spent the last decade analyzing financial markets, building wealth systems, and watching the same patterns play out over and over. People follow conventional advice, work incredibly hard, make all the sacrifices they're supposed to make, and end up decades behind where they could have been because they were optimizing for the wrong goal. The invisible equations controlling your financial future are not the ones you think they are. The path to wealth in 2025 looks nothing like it did in 1985. And if you keep following 1985 advice, you're going to get 1985 results in a 2025 economy, which means you're going to get destroyed. Let's start with why homeownership was actually a wealth-building strategy for your parents and grandparents. Because it was. This isn't about pretending the old advice was always wrong. From 1950 to about 2000, buying a home was one of the smartest financial moves an average American could make. You could get a mortgage at 3 to 5% interest, rates that stayed relatively stable for decades. Homes appreciated at a predictable 3 to 4% annually. Most importantly, wages were growing with housing costs. If home prices went up 4%, your salary probably went up 4% too. The system was roughly in balance. You were buying an asset with cheap leverage, capturing appreciation, and building equity while your income kept pace with the costs. That formula worked. It created millions of middle-class millionaires. But here's what changed. Mortgage rates today are over 7%. They were 3% in 2021. That difference alone changes your monthly payment by 40% on the same house. Home appreciation has been running at 8 to 12% annually in most markets, which is completely unsustainable. And wage growth? 3 to 4% if you're lucky. The system isn't in balance anymore. Housing costs have diverged from income in a way we haven't seen since the 1920s. In 1970, you needed roughly 2 years of median household income to buy a median-priced home. Today, you need nearly 8 years, but it gets worse when you calculate the true cost, because nobody calculates the true cost. Everyone focuses on the mortgage payment. Can you afford $5,200 a month? But that's not what homeownership costs. Property taxes increase an average of 3 to 5% annually. Homeowners insurance is up 33% since 2020 in many markets. And if you're in Florida or California, good luck. Maintenance runs 1 to 3% of your home's value every year. That's $8,000 to $25,000 annually on an $800,000 home. Then there's the opportunity cost of your down payment, which nobody includes in these calculations, and it's the biggest cost of all. Let's run the real numbers on that $850,000 house. 20% down is $170,000. Your monthly mortgage at 7% is $5,200. Property taxes, insurance, and maintenance add another $1,100. You're at $6,300 a month to live in an asset that might appreciate, might not, and that you can't access without selling or taking on more debt. Your net worth might look great on paper, but you can't eat equity. You can't pay for your kids' college with equity. You can't retire on equity unless you sell the house. And then where do you live? Now let's talk about what you could have done with that $170,000 down payment. If you invested it in the S&P 500, which has returned an average of 10% annually for the last 50 years, you'd have $1.1 million in 20 years. If it sits in home equity, appreciating at 4%, you'd have $371,000 in 20 years. The difference is $729,000 in lost wealth. And that's before we account for the $3,300 a month difference between your mortgage payment and what you could be paying in rent. If you invest that difference every month for 20 years at 10%, that's another $1.2 million. We're not talking about small differences here. We're talking about the difference between retiring at 55 with financial independence and working until you're 70, because all your wealth is locked in a house you can't sell because you need somewhere to live. But there's an even bigger cost that nobody talks about: the flexibility premium. When you're house poor, when $6,300 a month is going to housing, you can't chase opportunities. Your friend starts a company and needs an early investor. Can't do it. Your industry is dying in your city but booming in another state. Can't move. The stock market crashes and everything's on sale. No cash to buy. You get a job offer that would increase your salary by $50,000, but it's across the country. Sorry, you're locked in. The wealthy understand something that breaks people's brains. Homes are not assets for most people. They're liabilities dressed up as assets. An asset puts money in your pocket. A liability takes money out. Your primary residence takes money out every single month and gives you nothing back until you sell it. Meanwhile, actual assets, stocks, bonds, businesses, rental properties that other people pay for, those put money in your pocket while you own them. 40% of millionaires rent their primary residence, not because they can't afford to buy, because they understand the math. Let me show you exactly what this looks like with real numbers. Path A, the traditional homeowner. You scrape together $170,000 for a 20% down payment on an $850,000 house. Congratulations, you just locked up nearly $200,000 in an illiquid asset. Your monthly payment, $5,200 for principal and interest at 7%. Property taxes, $700 monthly. Insurance, $400 monthly, and that's going up 30 to 40% every few years now. Maintenance and repairs, 1% of home value annually. That's another $708 per month. Total monthly cost to live in this house, $7,008. Every single month for 30 years. Now let's run Path B, the strategic renter. You rent a comparable 3-bedroom for $3,000 a month. That's the current market rate in most major metros for what you'd get in an $850 house. You take that $170,000 you didn't spend on a down payment and invest it in a diversified portfolio, S&P 500 index funds, total market funds, boring stuff that actually works. Then every month, you take the $4,008 difference between your rent and what the homeowner pays, and you invest that too. Automated, first of the month, no thinking required. 20 years later, let's see where we are. The homeowner, their house appreciated at 4% annually. That's the historical average, not the insane run-up we saw from 2019 to 2022. Their $850,000 house is now worth $1.86 million. Sounds amazing, right? They paid down about $300,000 of principal over 20 years. So total equity, $1.3 million roughly. But here's what nobody tells you. They spent over $1.68 million in total payments over those 20 years. Mortgage, taxes, insurance, maintenance, all of it. And that doesn't include the opportunity cost of that initial $170,000 down payment. The renter, that $170,000 initial investment at 10% annual returns, the historical S&P average, is now worth $1.14 million. The $4,800 they invested monthly for 20 years, that's another $2.38 million. Total liquid net worth, $3.52 million. In cash, in investments they can access, not locked in walls and foundation. The wealth gap is $2.22 million. The renter has more than double the net worth of the homeowner. And here's the part that really matters. The renter can actually use their wealth. They can retire early, they can start a business, they can weather a job loss without losing everything. The homeowner, they're rich on paper and broke in reality. They can't access that equity without selling their house or taking on more debt through a HELOC at whatever predatory rate the bank decides to charge. But wait, you're thinking, what about the tax benefits? Mortgage interest deduction, that's supposed to make homeownership worth it. Let me destroy that myth right now. The standard deduction for a married couple filing jointly in 2025 is $29,200. To benefit from itemizing your mortgage interest, your total itemized deductions need to exceed that. In the first year of an $850,000 mortgage at 7%, you're paying about $58,000 in interest. Sounds like a lot. But after you factor in the standard deduction you're giving up, your actual tax benefit is maybe $8,000 to $10,000. On a mortgage payment of $62,400 annually, you're getting back 16% at most. And that benefit decreases every single year as you pay down principal and less of your payment goes to interest. Meanwhile, the renter investing in a taxable brokerage account pays long-term capital gains rates of 15 to 20% when they eventually sell, and they control exactly when they realize those gains. They can tax loss harvest, they can let winners run for decades. The homeowner gets one big tax exclusion when they sell, $250,000 for single filers, $500,000 for married couples, but only if they lived there 2 of the last 5 years. Miss that window and you're paying capital gains on the full amount above your cost basis. Here's what really separates these two paths. Flexibility. The homeowner made a bet that locked them into a specific geographic location for at least 7 to 10 years. That's the break-even point where buying starts to make sense over renting. And even that assumes everything goes right. No job loss, no divorce, no need to relocate for a better opportunity, no major repairs that insurance doesn't cover. The renter, they can chase a $50,000 raise across the country. They can take a 6-month sabbatical. They can move to a lower cost of living area and cut their expenses in half while maintaining the same income with remote work. That flexibility has a monetary value that never shows up in rent versus buy calculators. Let me tell you about career mobility, because this is where the math gets really ugly for homeowners. Study after study shows that people who own homes are less likely to relocate for better job opportunities. They're anchored, literally. The transaction costs of selling a house, 6% to realtors, 1 to 3% in closing costs, that's 7 to 9% of your home's value just to get out. On an $850,000 house, that's $60,000 to $76,000 in friction costs. So when a recruiter calls with a job that's a 30% raise but it's in a different city, the homeowner has to think about it. They have to run the numbers. They have to consider timing and market conditions. The renter says yes, gives 30 days notice and moves. Over a career, that difference in mobility is worth hundreds of thousands of dollars in cumulative salary gains. And we haven't even talked about what happens when markets shift. Remember 2008? Everyone focuses on the people who lost their homes. But the real victims were the people who didn't lose their homes but couldn't move. They were underwater, owing more than the house was worth, trapped in cities with dying industries and no job prospects. The renter in 2008, they just moved. Picked up, relocated to where the jobs were, started over. No strategic default, no credit destruction, no walking away from an asset that became an anchor. Now let's address the elephant in the room. What about the crash? What about waiting for housing prices to collapse so you can buy at the bottom? Here's the truth about market timing that's going to make you uncomfortable. The people who got rich buying foreclosures in 2009 and 2010 weren't regular people. They were investors with cash reserves, perfect credit, and stable income, at a time when banks weren't lending to anyone who didn't have all three. The best deals in a crisis go to people who don't need them. If you're sitting around waiting for a crash so you can finally afford a house, you're planning to have enough cash and financial stability at the exact moment when most people have neither. That's not a strategy. That's a lottery ticket. And here's what nobody wants to hear. The crash might not come, not the way you're imagining it. We have an inventory crisis in this country. 4 to 6 months of supply is considered balanced. We're sitting at 2.8 months. There aren't enough homes. Boomers are aging in place instead of downsizing. Institutional investors, Blackstone, Invitation Homes, Zillow before they imploded, they're buying up 16% of available inventory and converting it to rentals. New construction hasn't kept pace with household formation since the Great Recession. Builders are still gun-shy after 2008. What's more likely than a crash? Stagnation. Prices stay elevated, maybe tick down 5 to 8% in some markets, but they don't collapse. They just stop going up. And wages slowly, painfully, over a decade, start to catch up. Maybe. That's not a crash you can time. That's just a long, painful period where housing remains unaffordable and you're still sitting on the sidelines. The prediction everyone's missing is demographic. Boomers are the wealthiest generation in history, and they own a disproportionate amount of housing. Eventually, between 2028 and 2035, they're going to start selling. They'll downsize, move to assisted living, or pass away, and their kids will inherit and liquidate. That's when supply finally increases. But who's buying? Millennials and Gen Z have less purchasing power than any generation since the Great Depression when adjusted for housing costs. If there aren't enough qualified buyers, prices have to come down or institutional investors buy everything, and we become a renter nation. Here's the play. The patient renter who's been building liquid wealth and index funds for the next 5 to 10 years, they're positioned to strike during that transition. They'll have cash when supply increases and demand softens. Or, and this is the better outcome, they'll have built enough wealth that they don't need to buy. They'll have a $2 or $3 million portfolio, throwing off enough passive income that housing becomes a lifestyle choice, not a financial necessity. Let me show you what this looks like in practice with Geographic Arbitrage. This is the wealth hack that remote work unlocked and most people still don't understand. Take a software engineer making $150,000 annually. If they live in Austin, they're paying $2,800 a month for a 2-bedroom apartment. If they want to buy, they're looking at $850,000 for a starter home. But if that same engineer moves to Lisbon, Portugal, they're paying $1,400 a month for a comparable apartment. Same job, same salary, half the housing cost. That's $16,800 annually in savings. Over 10 years, invested at 10% returns, that's $284,000 in additional wealth, just from the rent differential. But it gets better. In Lisbon, their cost of living for everything else, food, transportation, entertainment, is 30 to 40% lower. They're saving another $1,000 monthly easily. Now we're talking about $420,000 in additional wealth over a decade. Same career, same skills, different location. You don't have to move to Europe. The domestic version works too. Rent in New York or San Francisco for your 20s and early 30s. That's where the career growth is. That's where the network effects are. That's where you build skills and relationships that compound. Pay the premium for rent because you're investing in human capital. But don't buy. Build your portfolio. Then in your late 30s or early 40s, when you've maxed out your earning potential and your network is established, you can work remotely from Boise or Nashville or Raleigh. Buy a house with a massive down payment or cash if you want, or keep renting and living off your portfolio. The point is, you have options. The person who bought in San Francisco at 30, they're locked in. They're paying a $7,000 mortgage for 30 years on an asset that might appreciate or might not. This brings me to the most important framework, the 3 paths forward. Because I'm not saying never buy a house. I'm saying understand what you're actually doing and make an intentional choice. Path 1, the aggressive renter. This is for people who want to maximize wealth accumulation. You rent below your means, 30% of gross income maximum. You invest the difference religiously. Automated transfers, first of the month, no willpower required. Your target is $500,000 to $1 million in liquid investments by age 40. At that point, you have options. You can buy a house with cash or a huge down payment if you want, or you can stay free, living off 4% of your portfolio, and housing becomes just another expense you cover with passive income. Path 2, the strategic buyer. You only buy if you're planning to stay 10+ years minimum. Your total housing payment, including taxes, insurance, and maintenance, is less than 25% of your gross income. You're buying in a market with actual job growth and inventory, not speculating on appreciation. And ideally, you house hack. You rent out rooms, you build an ADU, you buy a duplex and live in one unit. You treat the house as a lifestyle choice that pays for itself, not as an investment.